You got the raise, or the promotion, or you switched to a better-paying job, and for about 2 weeks, maybe 3, it felt like everything was about to get easier. But then the next month came, and somehow you're still worried about money, still checking your account before making decisions, still feeling that low hum of financial anxiety that never quite goes away. And the strangest part? You're earning more now than you were 2 years ago, maybe significantly more, but the stress hasn't decreased. If anything, it might have gotten worse. You're not imagining it, and you're not doing something wrong. This is one of the most common patterns in modern financial life, and it happens to people who are genuinely responsible with money, people who pay their bills, who don't blow their paychecks on impulse purchases, who are trying to do the right thing. So what's actually happening here? The first thing to understand is that when most people earn more, their life doesn't stay the same with extra money left over. Their life changes to match the new income. And this isn't about being careless. It's about how money actually works in real life. Here's what it looks like. Someone gets a salary increase of, say, 15 or 20%. That's real money. But around the same time, maybe 6 months before or after, they also move to a slightly bigger apartment because the old one felt too cramped. Or they finally replace the car that's been giving them trouble for 2 years. Or they start sending their kid to a better school. Or they take on a small renovation they've been putting off. Or they upgrade their phone plan because they need more data for work. None of these are reckless decisions. Each one makes sense on its own. But together, they absorb the raise. And because these are ongoing expenses, not one-time purchases, the money never builds up, it just flows through. So the income is higher, but the baseline cost of life is also higher. The gap between what comes in and what goes out stays roughly the same, and that gap is where the stress lives. Then there's the fact that as people earn more, expectations around them shift too. When you're in your 20s and making less, it's normal to skip certain things. You don't go to every wedding. You don't always buy gifts. You say no to trips. People understand. But when you're in your mid-30s or early 40s and earning a decent salary, those same choices feel harder to make. There's this quiet pressure to show up, to contribute, to participate. Family expects a little more. Friends assume you can afford things. Kids notice what other kids have. And it's not that people are materialistic, it's that the social cost of saying no increases as your income rises. So you say yes more often, you cover things, you stretch a little. And all of that is invisible. It doesn't show up as a line item in a budget, but it shows up in the account balance at the end of the month. Here's another thing that happens. As income grows, so does access to credit. Banks start offering higher limits. Loan approvals come easier than a year or two ago. Now they look manageable on paper. And this creates a quiet trap. Because what looks affordable in monthly installments can still be a massive long-term commitment. Someone earning well might take on a car loan, a home improvement loan, maybe some credit card debt from a medical expense or an emergency. Each monthly payment is reasonable, but when you add them all together, they take up a significant portion of the paycheck, and they don't go away for years. So the income is higher, but a large chunk of it is already spoken for before the month even starts. What's left over has to cover everything else, and that's when the tightness shows up again. The stress isn't coming from overspending on luxuries, it's coming from being locked into a structure where most of the money is already committed. There's also the issue of one-time costs that keep happening. A laptop dies, a medical bill arrives, the fridge stops working, a family member needs help, the car needs a repair that insurance doesn't cover. These aren't regular expenses, so they don't fit neatly into a monthly budget, but they happen often enough that they're not really surprises either. They're just part of life. And when someone is already running close to their limit each month, these irregular costs create pressure. They force decisions. Do I dip into savings? Do I delay something else? Do I put it on the card and pay it off later? Each decision is small, but the accumulation of these small decisions over time creates a background level of tension that never fully goes away.
So what actually reduces financial stress if earning more doesn't automatically do it? The answer isn't about making drastically more money or cutting everything to the bone. It's about creating margin. Margin is the space between what you earn and what you need to spend. It's the room to breathe. It's what allows you to handle the unexpected without panic, to make decisions without constant calculation, to feel like you have some control. And margin doesn't come from income alone, it comes from structure. The first part of building margin is understanding where the money is actually going, not in a judgmental way, just clearly, because many people who feel financially stressed couldn't tell you exactly how much they're paying each month in total fixed commitments. They know the big ones, but the smaller recurring payments blur together. So the starting point is getting that clarity, adding up everything that goes out automatically. Subscriptions, insurance, loan payments, memberships, services, all of it. Once that picture is clear, the question becomes, which of these are essential right now and which are adding to the baseline without adding much value? And sometimes the answer is that most of them are necessary, but even finding one or two that can be paused or reduced creates a little breathing room. The second part is being more cautious with new commitments. This doesn't mean never taking on a loan or never upgrading anything. It means recognizing that every new fixed cost shrinks the margin, and once margin is gone, stress fills the space. So before adding something that locks in a monthly payment for the next few years, it helps to ask, will this actually make life easier or will it just make the baseline higher? And sometimes the answer is yes, it's worth it, but sometimes it's not, and knowing the difference protects the margin. The third part is building a small buffer that sits outside the monthly flow. This doesn't have to be a massive emergency fund that takes years to build. It can start as something modest, enough to cover one unexpected cost without derailing everything else. That buffer changes the emotional experience of money, because when something goes wrong, the first thought isn't, how am I going to pay for this? It's, okay, this is annoying, but I can handle it. And that shift from panic to inconvenience makes an enormous difference in how financial stress feels day to day. The last part, and maybe the most important, is recognizing that financial stress isn't always about the numbers. It's often about the feeling of being trapped in a pattern with no flexibility. When someone feels like they have choices, even small ones, the anxiety decreases. When they feel like everything is locked in and there's no room to adjust, the anxiety increases. So part of reducing stress is protecting that flexibility, keeping some decisions open, not filling every available dollar with a commitment, leaving space for life to shift. This might mean earning more and choosing not to immediately upgrade everything. It might mean paying off one loan before taking on another. It might mean saying no now to preserve the ability to say yes later. It's not about restriction, it's about control. Earning more money can absolutely reduce financial stress, but only if the structure around the money supports it. Only if the increase in income doesn't immediately get absorbed by an increase in fixed costs. Only if some of that money is allowed to create margin instead of just maintaining a higher baseline. The people who feel financially calm aren't always the ones earning the most. They're the ones who've built a system where their money has room to move, where unexpected things can happen without everything falling apart, where decisions don't have to be made under constant pressure. And that system can be built at almost any income level. It just requires a different approach than trying to earn your way out of the stress. Because the stress doesn't come from not earning enough, it comes from not having enough margin. And margin is something you build, not something you earn. If this resonated with you, you're not alone, and you're not failing. You're just navigating a system that wasn't designed to make this easy. But with a little clarity and a little structure, it gets better. Thanks for watching.